How do you post the biggest sequential revenue jump in company history while essentially freezing your human hiring? Welcome to Earnings Unscripted. It is May 27th, 2026, and we're unpacking Q1 for Snowflake, ticker SNOW. Muriel, they run the data warehouse basically everyone uses, but I am still stuck on the headcount number. It feels completely paradoxical.
It is a total paradox. I mean, usually you see a company hit $1.39 billion in quarterly revenue, which is up 33% year over year, and you naturally assume they are building a small army to support it. But outside of a specific acquisition they made, Snowflake added exactly 17 net organic employees globally. 17! It is basically the AI efficiency thesis quantified in a public filing.
Which is, it just sounds completely made up. And quickly, just to keep the lawyers happy, this is just us talking, not actual financial advice. But clearly, the market absolutely loved the narrative. I mean, the stock was completely in the wilderness all quarter. It dropped like 28% at one point, and then it immediately went vertical at the bell today. A massive 35% rip up to near $240 a share after hours. I suppose non-GAAP EPS jumping up to 39 cents a share helped.
It did, but the street was really reacting to a death of a narrative. People thought, a lot of analysts assumed their core consumption model was running out of breath. Then Sridhar, the CEO, comes out and points to their strongest product dollar growth ever. And on top of that, non-GAAP operating margin actually expanded by over 300 basis points to 11.9%. So they're accelerating their top line and increasing profitability at the exact same time.
Okay, wait, so how are they actually doing that? Because if they are pushing all these new agentic AI features like that new Cortex Code tool, AI compute is famously expensive. How do you push that out to thousands of accounts without completely crushing your gross margins or hiring a tiny army of support reps to handle the rollout?
Right, that is the real magic trick here. And we should probably unpack the gross margin side, but the short answer on the support side is dogfooding. They deployed that Cortex AI internally to pre-analyze their own incoming tech support tickets before a human engineer even reads them. And that single move cut complex case resolution time by 30%. That is why they don't need to hire. The product is automating the company that builds it.
That is so dystopian, but also, frankly, so elegant. All right, let's get into the details and look at how they're actually financing this AI compute under the hood without breaking the balance sheet.
So the short answer is brute force leverage. They basically offset the entire cost of the new AI compute by shaking down their cloud provider.
Okay, explain that, because you do not just shake down AWS.
Well, you do if you are dropping $6 billion on them, and that is exactly what Snowflake did. Brian Robbins, the CFO, just laid it out perfectly on the call. He said, and I'm quoting here, "Our AI products have a lower gross margin than our core platform. We're offsetting that and keeping the same product gross margin at 75% for the full year with lower bandwidth costs." And then he specifically calls out the massive new AWS contract to make the math work.
Wait, so let me make sure I have this right. They're subsidizing the expensive new AI products by forcing Amazon to make the underlying bandwidth cheaper.
Yes, exactly. It is actually a brilliant piece of capital allocation. They know AI agent tools structurally have worse margins. There's just, there's no way around the raw compute cost right now. But because Snowflake is so massive, they use their renewal leverage to squeeze Amazon on the back end so corporate gross margins stay magically intact.
The AWS bailout. That is kind of hilarious, but it also raises a question. If these AI tools are structurally less profitable, why push them so aggressively? Why even risk that pristine margin profile?
Because if they don't do it, someone else steals the action layer. This is where their new Natoma acquisition comes in. Have you looked at what they're actually building with Cortex Code?
A little bit. It sounds like they're trying to embed their AI directly into apps like Slack and Jira, right? Moving beyond just being a place to store data.
Right. It's the death of passive analytics. Sridhar calls it the agentic control plane. And to put a human face on it, he told this story on the call about a partner, Infinite Lambda. One of their engineers used Cortex Code to build an entire Customer 360 application from scratch, live dashboards, recommended actions, fuse data.
And how long does something like that normally take? A few months?
Oh, easily. But this engineer did it in 5 hours.
Wow. Okay, that is legitimately terrifying if you're an enterprise developer.
Exactly. Sridhar said the CEO of Infinite Lambda personally called him just to say, "You are changing this industry." So when you can give a client that kind of extreme velocity, you do not really care if the compute margin is a few points lower. You are making your platform completely irreplaceable.
So they are shifting from the place you go to pull insights to the engine that actually pushes work across the whole company. I get it. But, and sorry, I have to play skeptic for a second. Does the actual enterprise demand match that vision right now? Because looking at the backlog, I saw something that felt a little off.
You're talking about the remaining performance obligations, the RPO.
Yes, they highlighted a 38% year-over-year growth, which looks fantastic on a slide. But sequentially, quarter over quarter, that number actually shrank, right?
Yeah, it fell off a cliff. It dropped from $9.77 billion in Q4 down to $9.21 billion this quarter. So that's a sequential decline of over $500 million in contracted backlog.
So how do you have the strongest product revenue quarter in company history, but your future committed spend just evaporates by $500 million?
Well, the management line is seasonality. Sridhar explicitly blamed it on enterprise sales cycles, saying Q4 is just incredibly heavy on renewals. You sign the mega deals in January, and then Q1 naturally looks lighter.
Right. Everyone spends the leftover IT budget at the end of the year.
Exactly. And I think that's largely true, but it's an optical mess. I mean, it begs the question, are contract durations actually getting shorter because companies are scared of locking into AI cycles too early? I think that's the real risk hiding in the seasonality excuse.
Right, because the tech is moving so fast, you don't want to sign a 5-year deal if the model is obsolete in 6 months. That makes total sense. So with the margin tricks and the shrinking backlog, where does this actually leave their trajectory heading into the summer?
Well, if you look at their actual guidance, it leaves them accelerating. They just materially raised the full-year outlook. They bumped product revenue up to $5.84 billion, which is 31% year-over-year growth. And they even lifted the operating margin target to 13.5%. Robbins practically said on the call that the new AI tools layered into the model so well, they essentially had to raise the guide.
Which is, that is a pretty massive flex, especially when you remember their executive suite just went through a complete blender recently. You have got Brian Robbins stepping in as the new CFO, a brand new chief revenue officer, and, Benoit, the legendary co-founder, is stepping back from day-to-day operations in June. That is a ton of transition risk to swallow right when you are raising expectations.
It is, yeah, but delivering a print like this is exactly how a new brain trust buys goodwill from Wall Street. The old guard built the data storage system. Now Sridhar and the new team they're trying to own the actual action layer where work gets done. And frankly, adding basically zero organic headcount proves they're taking the efficiency mandate seriously. They're not just selling the AI automation dream, they're actively living it.
But they really are. We are literally watching a massive software giant use its own product to essentially evaporate job creation. It's completely brilliant for the balance sheet, but I don't know. It's a little sobering to see that AI hollowing out theory actually quantified in public markets.
Optimism with the spreadsheet, remember? Welcome to the new enterprise cycle.
Touche. All right, well, we'll see if their margin magic holds up through the summer. Thanks for digging into the numbers with me, Mero.
Always a pleasure, Susie.
By the way, if you want these earnings teardowns to just show up in your feed the second they drop, go ahead and hit follow on the podcast. This entire show is actually generated with the help of AI, really just to see if technology can help us pull the human story out of these massive corporate filings. So we would absolutely love to hear from you. You can drop your ticker request straight to Earnings Unscripted at datamadness.ca or just grab the X link in the show notes.
Catch you next time.